One question I get from clients when they come in is, how aggressive are you? I will try to fight for you to get every legal deduction you can. I will tell you where free deductions are, such as personal exemptions, standard mileage over actual expenses, domestic production deduction, which can give you up to 9% of net income off. As a tax preparer, I can accept what you tell me. You sign an engagement letter that says you have support for what you tell me. I am, however, required to make reasonable inquiry. If you tell me you drove 75,000 miles a year, I'm probably going to ask you to justify it. If you told me you drove 20,000 and 90% of it was business, that might be acceptable. Very few people drive 75,000 miles a year. If you inflate your deductions, currently that's not considered tax evasion. That was an error. If you don't report your income, that is considered tax evasion. So always report all of your income. If you're going to make a mistake, you're going to do it by over-deducting. If the IRS audits you and they find that you've been aggressive in some area and they catch you at it, they will start questioning all the areas and will probably be harsher on your supporting documents and disallow deductions that you may have actually paid for. What I sometimes tell my clients is that you pay for every deduction you get. You do not get to deduct everything you pay for. The IRS, when they're auditing, usually audits on an issue. They may be going around to electrical contractors and telling them they have to be on an accrual basis. They may be going around and saying, prove your home office is regular and exclusive. They may be looking at, do you have all the support you need for your meals and your entertainment? But they're going to be looking typically at something that flagged your return for them, and they're going to start there. If they find you have the support for it, they'll probably stop there. If they find you don't have the support for it, they're going to broaden their scope and audit more. The states are all hungry for money, and the state can also audit your income tax return. And the state has more teeth than the federal. The federal bill is usually bigger because state tax rates are less, but state is closer and they can bite harder. The state can pull your license. The state will usually audit all the items, not just an issue. So they're usually more time consuming and more closer scrutiny and more likely to find a mistake. Okay, keep good records, have support for what you're deducting, and it'll stand up to scrutiny and you can sleep at night and don't have to worry about the IRS coming. The IRS called, okay, Tuesday's fine. Let them come in. So know the rules, know what you can do within the limits, and try to live within those limits.